Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, and as always, Andrew Thrasher, Portfolio Manager. So happy to have you along. Hope everybody had a great 4th of July celebrating Independence Day. I appreciate you, Andrew, last week step up and filling in along with Zach. I was able to watch that upon my return, and you guys did an excellent job. And I was so happy to see a lot of people get introduced to Zach for the first time. See him part of the team because he's become a very integral part of what we do in the portfolio team on a day in, day out basis. So well done and appreciate that. Moving to today's topics, we've got 3 things for you. Inflation just seems to be something we talk about in some way, shape, or form, but there's so much nuance. So we're going to talk about it, but really highlight that it's not a U.S. phenomenon. It's global. We're going to talk about the difference between defensive versus leading stocks. And then also speak to the Fed credibility in a very unique way. So, Andrew, the first couple topics will be yours. So we'll head on over and talk about inflation.
Yeah, I have an interesting chart. This is obviously a question that we get asked quite a bit about inflation. And a lot of people's focus is domestic. They care about the cost of goods that they're spending. When they get gasoline, when they go to the grocery store. But we have to remember, we very much live in a global world. Globalization is very much still around, and inflation is part of that. The inflation that we're seeing here actually there's probably envious parts of the world that wish their prices were only as high as ours were, believe it or not. We can see here the inflation, headline inflation momentum on the far right, US, UK, Euro, Canada, Australia. You can see all of them are moving higher. But what I think is the most telling, most impactful is actually the chart here on the right, which looks at the share of the CPI basket, the Consumer Price Index. Is made up of a lot of different categories: food, shelter, many different products to gauge what is inflation. And so we're looking at how many of those items for each of these countries or groups of countries for like the Euro area, how many of them are rising by more than 5% year over year. And look at that, we have almost 2/3, almost about half of the countries or of the CPI baskets are rising more than 5%, well above what's traditionally normal, around that 2%, what the US Fed is always shooting for. And so the first question we often get is inflation, what's going on with inflation? Is it ever coming down? And the reason that we feel like it still could be sticky or at least bounce around a little bit is because it's global, because we're seeing prices across the globe rise. And it's not just related to what's going on here domestically. A lot of the blame game can be played politically, but we have to remember COVID-19 caused a lot of different changes in consumer spending. We saw a big shift from spending on services to goods. People were putting a lot of their 2020 and 2021 budgets towards toilet paper or food and things like that. They weren't doing a lot of service spending. We also had those big stimulus bills under Trump, the CARES Act 1 and 2, and then the third one under Biden. And then also just the Russian invasion of Ukraine caused a lot of issues with commodities, just-in-time delivery. I think when you buy something on Amazon and the fact that you can now almost select certain items to actually be delivered in a couple hours. So the buildup in inventory was a big contributor to that. A lot of companies were building up their inventory to meet the large spike in demand during that COVID time period. We also saw wages rise. Home prices, I'm sure you saw, were increased, and we had shortages in the housing market, and we could go on and on. But there's a lot of different factors that are just here domestically, but these also played out as well in Europe and Australia and Canada as well. A lot of these same types of issues that caused inflation globally to go higher.
Absolutely. And so take us now, one of the things that we always have to keep in mind is when you're looking at stocks or the S&P 500, there's a lot of different groups in that. And often you have the ability to invest in different types of stocks. And one of the ways we can break them down are those that are more offensive oriented and those that are defensive oriented. And this next chart, you're going to walk us through on which one of those two groups are outperforming for the time being.
Yeah, something I spend most of my days doing is slicing and dicing the market, trying to look at it from different angles, look at different types of stocks. Like Adam said, we can divide them up into those that typically rise when we're in an offensive, high risk appetite, real bullish environment. Those are most cyclical stocks, as you can see here: auto, energy, materials, technology, things like that, traditionally do well in rising uptrending markets. Then we can also look at the defensive basket, consumer staples, real estate, healthcare, things that typically investors will turn to when they're a little bit more risk averse, parts of the little bit more durable parts of the economy. You're still probably going to buy bread and underwear and eggs for consumer staples. You're probably still going to have your utilities, still going to need healthcare. So certain parts that will continue to see growth regardless of where that we are in the economic cycle. And so looking at how these two groups move against each other, if cyclicals are outperforming, that's great for the overall stock market. Shows that risk appetite is still very bullish. On the other flip side of the coin, when defensive stocks are what's been outperforming, and that's what we've been seeing in 2021, you can look at the bottom part of this chart where the cyclicals versus defensive line is going lower, which is telling us that defensive stocks are outperforming. And so we've recently seen a little bit of a bounce in equities, and then we want to see what was leading that charge higher. Well, unfortunately, it was actually the defensive stocks that were showing a lot more strength. Notably, consumer staples and utilities were some of the best performing sectors last month, and they continue to perform well as we get into July. And so while we're seeing equities get these little bit of a bounce, it hasn't really been on this burst of risk appetite, this increase in strength in cyclical stocks. It's actually been more on the defensive side, which gives us pause that maybe this isn't necessarily the bottom. We're continuing to evaluate that and trying to look for good opportunities. But from a risk appetite perspective, it still looks like the market's trying to be a little cautious, showing a little bit more favor towards those defensive sectors.
Awesome. Thank you, sir. So last point here, we're going to move back a little bit into the inflation camp, but from a different angle. And really that's titled Fed Credibility, and I'll kind of unpack why. But what we're looking at is inflation expectations. All right. So when I use that word expectations, there's a couple of major different ways you can do that. One is simply through surveys and polling and asking people, what are your expectations? Those aren't really helpful aside from a few nuanced ways in terms of how the Fed is going to view that data. But alternatively, we can look at market participants and the collective result of trillions of dollars worth of decisions to gauge how investors are viewing inflation going forward. And that's what we see on this chart here. The white line is essentially what the U.S. investors are expecting in terms of a 5-year average for inflation. And we really responded strongly at the earlier part of this year as inflation began to skyrocket. The 5-year average was expected to be over 3%. So they began to take off. They've actually been backpedaling and coming back down here recently. A lot of it might have to do with commodity prices coming down a little bit. The gold line is the 5-year average, but it's 5 years forward from now. So in other words, it's the market's way of saying, what will that be? What will that 5-year gauge be 5 years from now? And that has been remarkably stable. It actually hasn't moved around a whole lot. Even as we've seen inflation surge, the expectation going forward has not been that heavy. So that still is contained. That doesn't mean that's what inflation will be. That's its current view. But what this says to me is remarkable. The Fed has taken a lot of hits, but this is telling us that the bond market, the investors here, believe that the Fed will follow through and hike enough to bring inflation back down over the long run. We'll see if that happens. It might be a painful result to get there, but that is the current market view. And then maybe a silver lining here that the expectation has come down pretty rapidly over the past several weeks. So, hey, those are our points for this week. Thank you for giving us a little bit of your time. Don't forget, you got a chance to come in and see us, particularly if we haven't got the chance to see you for your family update, or if we don't do business with you, please, by all means, come in for your next steps meeting and see how we might be able to help you. You can scan the QR code or give us a call, 800-928-4001. And lastly, don't forget that we have a radio show that you can listen to on a weekly basis over the airwaves, WIBC locally, or in a more convenient form, however you get your podcasts. So thanks again, and everyone, please have a great weekend.